Hello students, welcome to final week of our mathematical theory of interest course. So basically in today's lecture we will discuss about the term structure of the interest rate and the derivatives. We will discuss what are the important components of the interest rate, and we will define what is derivative and how it works, what are important function of the derivatives. All these things we will discuss in detail in today's session. So quickly moving to the chapter review. So basically in the last lectures we discussed in detail about the interest rate, um, with the assumption that there is only one economy wide interest rate of the course. Of course that is not really the case. So basically in today's discussion we will discuss what are different kind of interest rate prevailing in the society and on which basis we can divide interest rate for the financial products. First of all, we will examine the bonds that offer similar payment streams but differ in prices. The price differences are basically due to the risk structure of the interest rate. There are 5 different components of the interest rate. Based upon these components, or we can say that there are 5 different risk factors that will affect the rate of interest, including the liquidity risk, maturity risk, default rate risk, and exchange rate risk. And we will discuss all these kinds of risks and their impact on the interest rate in detail in this lecture. Next, we will look at the different rates that are required on bonds with different maturities. This is known as term structure of the interest rate. How the time to maturity will affect the determination of the interest rate, that we will discuss after that. So basically there are 2 focus points in our today's discussion. First we will discuss about the risk structure of the interest rate, and secondly we will discuss about the term structure of the interest rate. That will be 2 focus points of our today's discussion. So quickly moving to the risk structure of the interest rate. We first examine the yield for several categories of long-term bonds over the last 85 years. The yield may be, this is actually the trend. This is actually the trend of US long-term bond market starting from 1920 till 2010. We can see that during early 1930s, the government corporate bar bonds value has increased too much, and again this trend was observed in during 1980s, and after 2000 the bond interest rates has been decreased as far as corporate AAA bonds, corporate BAA bonds, and US government long-term bonds. They have started decreasing. Why the interest rate has changed over the time period? There are multiple reasons behind it. The important things that we have learned from this diagram: first of all, the rates on different bond categories change from year to year for the next, and spreads on the different bonds categories change from one year to the next as well. There are multiple reasons behind the change in interest rate. The most important, here are 3 most important risk factors that will affect the determination of the interest rate. What are these risk factors? First of all, default risk, then liquidity risk, and income tax consideration. Default risk is basically the chances of default of the issuer. Chances of default of the issuer will affect the interest rate. If the chance of default is high, definitely high risk will be involved, and lower will be the interest rate. Then the liquidity of the determinant. If the bonds or any financial instrument is more liquid, the interest rate will be high. If it is less liquid, the interest rate will be lower. And obviously the income tax rate, if the income tax rate is high, it will affect the price of it will affect the interest rate inversely. Here is the detailed explanation of all these three risk factors regarding the default risk factor, regarding the this is the graphical representation. The default risk factor, as the default risk factor increases, what is going to happen with the risk premium and with the price of the bonds. For example, D1, DC1 and SC. SC refers to the supply of the bonds and C refers to the demand of the bond. If the price of the bond, if the demand decreases, what will be the new equilibrium price? The equilibrium price will also decrease from P1 to P2. That will be the new price. And if the demand increases, the price will also increase. This is the equilibrium price will also increase. Now next, moving, these are the important we can say that the shifts or shocks in the interest rates with different economic conditions. For example, for treasury bond market, the RE on the corporate bonds, if it will decrease, the demand will also decrease and the DC will shift to the left side. So we can say that if the price will decrease, the interest rate will increase. It has a negative relationship. For treasury bond, it will also follow the same trend. As we can see that the relative RE on treasury bond, if it will increase, the demand of that bond will also increase and the DT will shift to the rightward. So finally we can say that if the price of treasury bond will increase, the interest rate will decrease. And final outcome or risk premium, we can say that is the IC and the IT. IC and the IT. It is basically the default risk factor is a very important component of the size of the risk premium. Because of this, bond investor would like to know as much as possible about the default probability of a bond. Here is the bond rating according to Moody's and Standard and Poor's. This is the comparison. What is meant by AAA according to Moody, and what is the Standard and Poor's rating AAA? What is meant by that? So basically, they determined according to the risk factors. They determine the credit rating of different companies' bonds according to the risk factors involved. For example, if we look at the A category, A for Moody's and Standard and Poor's, it refer to upper medium grade type of bond. And normally Harley Davidson, Hewlett Packard and McDonald Incorporations, these companies' bonds are categorized under A category. And when the category is decreasing, it means the risk factor is increasing. For example, in D category of the Standard and Poor's, it is highly speculative, and C category of Moody's, it is highly speculative. And the companies Calpine Corporation, Citation Corporation and Delta Airlines bonds are basically categorized under this category. Their shares are highly risky. They are highly speculative. Here is a case from the Enron and the BAA and AAA spread. You can just go through this case by yourself to have more clear understanding. Second risk factor is the liquidity factor. It is another contributor of a bond that influences its interest rate is its liquidity. A liquid asset is one that can be quickly convertible into cash, quickly and cheaply converted into cash if the need arises. If the need arises. Here is the graphical explanation of these kinds of bonds. So liquidity, basically in liquidity, in the first example we can see that if the liquidity increases, the bond price will also increase and the interest will decrease. Here is like the explanation of these demand and supply curves according to their liquidity. For example, in case of corporate bonds, the liquidity of the corporation, if it will decrease, it will also decrease the DC, demand of that particular curve, and the DC will be shifted, and the price and the interest of the corporate bond will have opposite relationship. And in case of treasury bond, if the price increases, the interest on these treasury bonds will decrease, so it will have a negative relationship. So the risk premium, by comparing the treasury bond and the corporate bond, it will be basically equal to the difference between corporate bond and the treasury bond, and it will increase. The difference between interest rate on the corporate bond and the treasury note, that is the risk premium, that reflect not only the corporate bond's default risk but its liquidity too. This is why a risk premium is sometimes called a risk and a liquidity premium, a risk premium or a liquidity premium. Now the third factor is the income tax factor. What is going to happen with the price and the interest of a particular type of bond with the increase or decrease in income tax? An odd feature is explained in figure number 1. We can get a very clear idea. The interest payments on the municipal bonds are exempt from the federal income tax, a factor that has the same effect on the demand and for the municipal bonds as an increase in their expected return. Here you can see more explanation with examples. Here is the graphical explanation of the tax advantage of the municipal bond. We can see that in case of municipal bonds, when the tax exemption will increase, the return on the municipal bond will also increase. And in case of treasury bond, relative R on treasury bond will decrease with the decrease in demand of the treasury bond, and it will be shifted to the left side. So outcome will be, in case of in the municipal bond, interest will always be lesser than the treasury bond interest. Here is an example, the case. You can just go through this case by yourself to get a more clear and better understanding of the concept. It's the case from the Bush tax cut and the interest rate during 2001, when President Bush has decided to cut the taxes, to lower the taxes. Now the second topic of our today's discussion is about the term structure of the interest rate. Term structure is basically the time to maturity of the interest rate. Bonds with different maturity will yield different. This is the Wall Street Journal. According to Wall Street Journal, we can see that the treasury yield curve is upward sloping. Interest rates for different maturities move together. We see in this example we can easily see that for 3 months bill, for 20 years bond, for 3 to 5 years bond, they go side by side. They have similar kind of trend over the last 55 years, but their spread will be different. Sometimes their spread will increase, sometimes their spread will decrease. So there are basically three theories of the term structure: expectation theory, market segmentation theory, and liquidity premium theory. Expectation theory tells us it is the pure expectation theory, which explains 1 and 2 but not the 3. I'm sorry. Later on we will discuss in detail about these theories. Here are some key assumptions of the expectation theory. You can just go through these assumptions by yourself. The important point in this theory is that if the expectation theory is correct, your expected wealth is same. This is mathematically, we can solve the questions, we can make a comparison between we can calculate the expected return, which will be approximately equal to IT plus IET plus 1, next year's interest. This is the strategy 2. How we can calculate? This is the average expected return. And next, moving about the expectation, these are some more explanations about the expectation theory and the key structure fact about this concept. Now here is the explanation for fact 3 and fact 2. You just go through this by yourself. If you have any question, you can ask me. Now quickly moving about the market segment theory. According to market segment theory, we have some key assumptions, which is bond of different maturities are not substitute at all, and secondly, in the implementation, the markets are completely segmented. Interest rate at each maturity are determined separately. Third one is the liquidity premium theory. The assumptions for liquidity premium theory are bonds of different maturities are substitutes, but are not the perfect substitute. And implications of the liquidity premium theory is basically the modifies pure expectation theory with features of market segmentation theory. And normally investors prefer short-term rather than long-term bonds. That implies that the investors must be paid positive liquidity premium to hold on for the longer time period. Here is some mathematical explanation. Graphically we can explain like this. Here is a numerical example. You can just go through this numerical example by yourself, and here is some market predictions of the future short rates. There are 4 different cases. In the first case, the yield to maturity is increasing with the time to maturity. In the second, the rate of change is smaller. When in the third case, the yield to maturity is independent from the rate of change in time to maturity. Here are some evidences of the term structure. The case, you can just go through this case by yourself, and if you have any question, you can ask me. Here is a very simple example to explain about this concept. This is the generalized form. So finally we can say that risk structure of the interest rate, we examine the key components of the risk in the debt, default, liquidity and taxes. These 3 components we have discussed, 3 impacts. In the term structure of the interest rate, we examined the various shapes of the yield curves can take and theories to explain this and prediction of the future interest rate based upon these theories. This is all about the today's discussion. If you have any question, you can ask me. See you in the next class, and we will continue this topic. Thank you so much. Bye bye.